Time to get back home and recap what happened on the Lal Street. Well, the Lal Street was largely looking at range-bound trade, but it was that last 1 hour where the drama took over and we had a negative close, a cut of about 0.3%. IT stocks did pretty well today, but then there were a lot of other large-cap names that were sulking around. So that was the net result. Mid-caps relatively outperforming. The mid-cap index was positive. Banks actually fared quite okay today. Not all of them, but some names like Axis Bank stood out. Let's come to the fund flow picture here. Now, as of now, we're not seeing any return of the FII because last couple of days we've been in sell zone. That continues today. Today's number is touching almost 612 crore rupees. So that's the total outflow that we've got. Domestic institutions also on the sell side today. So those are the trends. Okay, now let's say hi to Mayuresh Joshi, who's joining us as our market master this evening. Mayuresh, thanks so much for joining in. Big global event out of the way. What next for our market?
Evening, Surbhi. So again, with the Fed hiking rates as expected and anticipated by the markets, you have largely seen the emerging market sell-off continue. So to that extent, I think the bond sell-off that we've seen so far might very well continue with signs that we're probably getting from the US markets of the economy strengthening, joblessness probably coming down, inflation probably hitting that 2% mark over the next few years, and what probably Trump does with his infrastructure spending in giving a fillip to the US economy. But largely, I think the Indian economy still stays strong within the emerging pack. And though we've got demonetization as a roadblock in terms of the earnings picture over the next 2 quarters, as normalization resumes, because to a large extent, the markets have factored in a soft and tepid Q3 coming through, and even a soft and tepid Q4. So I think as normalization resumes, the second half should reasonably start seeing more resilience. The first half of FY18 should have a better earnings profile. And though the capex picture will also get delayed by a few quarters, the Indian economy still holds in good stead, both in terms of reform processes and the kind of corporate earnings picture that one really builds. The downgrades might happen, but again, I think India stands out among the emerging pack. So again, I think the market's expected to probably stay in a range over the next few weeks unless we get further clarity on how actual numbers are panning out in Q3. So it's going to be more stock-specific action at this point of time rather than markets which I feel would be in a range over the next few weeks.
Okay, all right. Let's just look at the deal news that we got this evening before we talk more about the stocks that perhaps you can pick that Mayuresh is willing to talk to us about. Well, Claris Life Sciences, that's pretty much where the headlines were coming in from. And as expected, as we were telling you earlier, the confirmation came in this evening. The company has sold off its injectables business to Baxter, and it's going to be fetching over $600 million as part of this deal. The question really is what's left with Claris, because injectables was a big part of its business. We'll get our colleague Ekta in just a minute. Let's actually tell you what some of the analysts on the street are saying about this. We were in conversation with Vishal Manchanda of Nirmal Bang just a while back. Take a look.
It depends on 2 things. One is how much of the cash that would be that would come to the parent company is disbursed to the shareholders as dividend. One, and the other is the tax implications on the transaction would also be important. So how much tax the parent company would have to pay on the capital gains they make on the subsidiary sale, basically.
Okay, Ekta is our in-house expert. So, Ekta, what are you expecting on the stock tomorrow, A? And B, sort of the longer-term picture for Claris's shareholders? Because injectables was a large chunk of its revenue, right?
Hi, thanks, Surbhi, for that. Well, absolutely. You know, starting with what we are expecting on the stock performance tomorrow, I definitely expect the stock to be up. And the reasons for that is twofold. One would be the valuations at which the deal is struck. Remember that Claris is largely a producer of injectables which are vanilla in nature. So that means that it's not really a specialty injectable maker, but it makes injectables which are possibly easily replicable as well. So the reason being that despite that, they have high operating efficiency, which has actually resulted in the 15 times EV to EBITDA valuation that they've received, which in fact is, very similar to Gland and Fosun and what they received, and is lower than what you receive in terms of specialty injectable makers, but is good for a Claris Life Sciences deal, which has taken place. Now, the other additional point is that there's going to be a significant amount of funds which is possibly going to be repaid to shareholders. Post the tax payment, the cash in hand should be around 3,000 odd crores. And the management has said that a significant part will be put back into the company and given back to the shareholders. So that too will be an important cue to watch out for. And that's the reason why I expect the stock to be up in the green tomorrow.
All right, Ekta, thanks so much for that quick analysis. Mayuresh, your own thoughts on pharma, as a universe, and typically what would you pick? Because it's all very, very stock specific within pharma. We saw, the impact on Sun play out today, certain concerns even around Aurobindo earlier this week. So what would you pick from pharma?
So again, largely, Surabhi, if I have to pick and choose within the large cap names, Lupin is something that will be picking on a staggered basis. Largely, if you look at the product profile, they've got almost $13-14 billion of drugs in the pipeline in terms of A&D applications. They've got 45 exclusive FDFs. And the management is very, very confident of around 25-30 odd launches. Yes, I think the FDA concerns are imminent for a whole host of pharma companies, but with the AIR that they've received for their Goa plant, my own sense is that the kind of launches that one really expects, both from its own portfolio as well as from the Gavis portfolio, where it expects the portfolio to remain extremely strong and robust in terms of top line, $250 million in FY17. I think that can very well continue. The domestic business is on a very strong footing. They've got an early entry advantage in Japan, where around $13-14 billion of drugs can go off patent over the next few years as well. So my own sense is that a 17% top line and earnings growth can easily be achieved by Lupin over the next 2 years. My own sense is that an EPS of around 70 rupees can easily be achieved. So I think Lupin in a staggered manner is one of the top picks that we probably got out of the pharma space.
Okay, Mayuresh, quick last word then. Overall strategy for the market, what would you advise buying?
So largely, again, if I have to pinpoint within the entire scenario of earnings being soft and tepid and demonetization actually playing a little bit of an havoc in terms of the consumer-facing industries, a few industries probably would not get impacted as much. So in that sense itself, I think gas distribution companies is something that I'll still lay my focus upon. There is huge underpenetration in terms of both CNG and PNG, and with the kind of cost reductions that we've seen in domestic gas to 2.8 MMBTU, that significantly reduces their cost of operations. Yes, the spreads might come down a little bit lower in terms of an SCM basis, but again, I think gas distribution is a space that I look out for. IGL has done exceedingly well, so investors holding on to IGL should continue holding on. Power transformer makers is somewhere where I believe the story still continues with the government focus on power. Around 15-16,000 crores of projects can be meted out over the next few years, and that can have a significant impact on their margins, which have languished at 4-5%, and return ratios, specifically ROCE, which is languished at 4-5% as well. So again, an uptick on orders with greater margins improves their cash flows. Margins probably come back to that 9-10% mark. ROCEs come back to that 8-9% mark, which gives a huge fillip to earnings. So investors, again, holding on to stocks like Voltam, transformers and rectifiers should continue holding on, both in terms of order wins, margin improvement, as well as the earnings profile improving vastly over the next 2 years.
All right, Mayuresh, unfortunately a little short on time today because of all the Fed action, but thanks very much for joining in and giving us some of those ideas around the market. We'll take a break and we'll come back with more.
CNBC TV 18, celebrating 17 years of business leadership.